let's go into the Silicon Valley Bank story. What do you think is going on there, and do you think it's the end of it? Obviously, yesterday Powell came out. A lot of people didn't think if he's going to increase interest rates or not.
Right.
Is this guy going to do it? Is he not going to do it? It's not a good time to do it. Maybe take a break for a month or two. We're seeing what happened with Silicon Valley bought a 10-year bond for $100 billion at 1.7%, thinking they're going to make it, and then bam, they have to sell that for some $20 billion, and the depositors are afraid. Those below $250,000, which is a small percentage, whatever the number was, 3%, they're covered. But the ones above, everybody's coming and saying, we got to bail the depositors out. What are your thoughts about what's going on with Silicon Valley?
Well, there's a couple of different issues. I mean, and you can sort of go down the line. The biggest issue is that in 2017, the Trump administration, the Republicans, and with some corporate Democrats as well, basically rolled back the regulations that were required for banks like SVB. It used to be if you had $50 billion worth of holdings as a bank, you were subject to the Dodd-Frank requirements about capital to keep the bank safe. And that would have also come along with like sort of subsidiary regulations and regulators being there to make sure that you can't make stupid decisions like that. I mean, they made some very stupid decisions that people involved in banking could take issue with, assuming that interest rates were always going to stay low, whatever. The point of regulations like that, where you take more or less a meat cleaver and you say is that people can make stupid decisions, but we're going to be here to protect the system and the depositors. The other thing that was going on there with all the depositors that had all this other money, this is a kickback situation. There's no doubt about it, right? Because anybody with $251,000 cash knows that there is a $250,000 FDIC limit. Mm-hmm. And if you're putting $500,000 in there or billions of dollars in there, you're getting something from the bank in return, which is low-cost business loans or like 0% mortgages. I'm sure you run into this. You put your money into some big, investment bank, you're getting kickback. You're getting a 0% mortgage. So you go out, buy a $13 million house. You don't have to pay anything for that money. You keep your money in a CD. And you're making money off of that $13 million house, essentially, that you bought.
Yeah.
Because you've just got that money borrowed cheap. And if they're going to do that, I mean, look, to each their own. If they're going to do that, they need to pay the consequences. They took a risk. I'm going to put my money in an uninsured bank because I'm getting back all this, and sometimes I think it was like they did this with their businesses, and then they get the personal mortgages, which is also, it's just a kickback. So I say we don't bail those people out because we have the rules, and these are the rules. Now, a lot of these people are big names. They have the ability to go on to every show that exists on TV and whatnot and claim that this is going to be a systemic risk. But I don't believe that, frankly. And so, I think what we need to do, and nobody's talking about it, is put the regulations back. We have now proof that it's dangerous to have rolled back the regulations on these mid-sized banks. And so, the deafening silence about it is amazing to me.
So, Sam, let me ask you, based on what you just said. So, so obviously we know the guys below $250,000, they're covered, but it's a small percentage with Silicon Valley Bank. It's not like it's a big number. The people above $250,000, with these guys that are coming out saying, hey, we gotta take care of these depositors because if we don't, all these other smaller communities and regionals are gonna get hit. These 27 regionals we have, one is gone, now it's 26. They're gonna remove their money and they're gonna put it in the big banks. This is one of the ways to nationalize it, and we're gonna go through only 5 banks and all this stuff. So the people above the quarter, you're straight up saying if you had more than a million, anything you had, let's not back them up. Let's not protect them. They lost the money.
I think there is that danger that you talk about, that there could be a run on these other banks. I think it's overstated, but I think there is a danger. And I think the way that you deal with that is you come out and you say, we're going to make sure that we're going to subject these 23 other mid-sized banks to the kind of regulation that we impose upon the bigger banks, so that the security you feel with those bigger banks, we're going to provide that security for you by regulating and making sure that they have the capital requirements that they need to protect your money.
Okay, so then go to, if I give you like a cause of to say it's this person's fault. Let's go through rankings of it, okay? Below $250,000, they obviously didn't do anything, wrong there. The guys above $250,000 in savings. Then you have the people that own shares in the company. They're shareholders of the company. Then you have employees that work for Silicon Valley Bank. Then you have the employees where the companies who banked with Silicon Valley Bank, where the payroll is stuck and they can't pay the payroll. Then you have the politicians coming up with the guidelines, the regulations. If you were to put the blame on those folks and who to take care of, who not to take care of, who would you put at the top? Who would you put at the bottom?
Well, I don't know how to apportion blame amongst those things, but I can tell you this: the but for in that situation is clearly the lack of regulation, right? I mean, I don't know who screwed up in all of those different levels, but I know that if they were subject to those same capital requirements, none of that stuff would have happened in the first place.
Yeah, it's kind of tough to debate that. Because I've been in the insurance business for 20-some years, right? You don't see a lot of insurance companies going out of business because insurance companies' capital requirements are a lot higher than banks' requirements. Banks can be a little bit more. We saw what happened in 2008 with the whole no income, no assets. Hey, Sam, how much money you made last year? $72,000. Sam, one more time. How much money did you make last year? $72,000. Sam, one more time. How much money did you make last year?
Right.
$158,000. Okay, great. How much you have in the bank, Sam? Hey, I got $28,000 in the bank. One more time. How much you have in the bank? $380,000. Perfect. No income, no assets, and then boom.
The ninja loans.
Loans, right? Everybody takes it. So there's a part of that I agree with. The whole ninja loan, it was never supposed to be for low and middle income families. The ninja loan, if I recall, came from Australian bank. It was something they were using. And we brought it to the States, and it was supposed to be more for like the clients at the Goldman and the higher. And then they said, let's launch this to everybody out there in the streets.
Yeah,
and that's where they took a hit.
You're a bank loan officer, right? There was a fiduciary responsibility by the person in that scenario there who kept saying put the number up, because I come in for a mortgage. I don't know. I'm not a financial whiz.
You know who we had here on the podcast 4 months ago? Very uncomfortable podcast. It was with the former CEO of WAMU. I don't know if you remember WAMU, Washington Mutual.
Oh, yeah. Oh, yeah.
Horrible. And that thing was a behemoth of a bank, right?
Yeah,
$330 billion.
I think, as far as I
Well, we had Kerry Killinger. By the way, he was kind enough to come in. I didn't know what he thought we were going to talk about. I banked with WAMU for years, and I loved WAMU. I thought it was a phenomenal experience. You'd go there, the customer service, the way you would feel like you're not at a bank. There's not a window where you feel like, hey, you can't shoot us. Everybody was open. There was a relationship thing that was going on. I said, what caused this? Why get so reckless about it? What made you think some of these things you were doing with the amount of money that you had were you ended up selling it for chase? So I guess, I don't know how much you follow the stories. Obviously, you're a guy that's been following every story every day because this is what you do for a living. What have we learned from 2008 that we're not repeating today? Maybe even the way Janet Yellen and the Fed is handling the bailout model. They're calling it a different thing. What's different about it today than it was in 2008, in your eyes?
Well, the situation is very different, too. I think, the amount of leverage that we're talking about in the system is just not nearly the same. And Dodd-Frank eliminated a lot of the more risky stuff. But, again, I can tell you, more importantly, what we didn't learn is when we rolled back those regulations. You and I, we could go through that whole thing. We could spend 6 months examining every aspect of what happened there, and we might come up with a different, who was really responsible, or there could be shared responsibility. But the bottom line, this is why you need regulation. Just like you said, in the insurance industry, you have a tighter regulation on this stuff. You don't allow for people to come in and play fast and loose with all this stuff, to gamble like they're at the racetrack, and then come for a bailout from us. Because look, the bottom line is, I know it comes from FDIC fees, but who's going to get those fees? And actually, the fees that are going to be imposed upon people to bail out guys like David Sachs and all these other right-wing so-called libertarian. There's suddenly libertarians looking for the government handout. But the people who are going to be paying off these fees more than anybody else are lower income people because they are stickier with banks. They don't have the opportunity to go around. They don't have the time. They don't have the inclination, the savvy to go around and shop around banks where they're going to get lower fees. Maybe they don't have the same amount of deposits in there, so they're not going to be. So that's who's going to get stuck with this bill.
So let's go back to this on what we can find default with. We can say, we need more regulation is what we need. We can say, it's the greedy banker's fault. We can say, hey, why are you being so reckless? You're putting all your money in the bank. You should never put all your money in the bank, right? You got to kind of diversify and put a little bit more money in different places.
Well, there's also something called sweeps, and everybody who's involved in a business knows this. I'm sure you know this, that there are third parties out there who will distribute those $250,000. They had those money there for a reason, and that I think it was kickbacks. I think it's probably going to come out in a couple of months after more investigation. But again, we don't have to spend our time worrying about who's to blame of those individuals. Maybe they all are.
No, this is where I was going. Oh. How old were you when you bought your first house? Do you remember?
I was, it was in 98.
Okay, so you got 20
I was
26
like 25.
years old.
Yeah,
Perfect.
25.
So 25 years old. What was the interest rate when you got in 98? Do you remember?
God, no.
Was it above 5, above 6?
I was an actor. I had a business manager at the time. I was making a lot of money. I was just
so you were living the dream.
Exactly.
Don't worry about the interest
rate. Can you
rate,
go to 1998 average 30-year mortgage? I don't know. Let's just Google it and see what the number was.
I imagine it was probably around 6.
Probably similar to what it is.
That's what I'm thinking. Yeah, I'm trying to see what it was. Okay, 6.91.
Yeah, very similar.
There you go. Okay, 6.9. By the way, I think that's where it needs to be for about a decade. I think the number needs to be there. And if you ask me, I think we need to go a little bit more old school in the way we buy stuff, right? Meaning, how much down payment you got? I got this much down payment. Great. And now you may disagree with that and say that's not going to be fair to low and middle income families. But I think there's part of it also, the guidelines to buy stuff has decreased. The guidelines to lend out money has decreased. Money became so cheap for such a long time where people were going out there getting money left and right. What are your thoughts on that?
Well, I know on mortgages, no, it's a lot stricter than it was, let's say, 15, 20 years ago. I mean, it's much harder. You need to provide much more documentation, and the loan companies are far more stricter. I mean, they're not quite where they were in the wake of the financial crisis, but they're still pretty tight. I mean, the problem I have with the raising of the interest rates is basically what Jerome Powell says every time he does it, which is we need to get more people unemployed. And that's, I mean, look, we can argue as to whether the Fed has the tools it needs to fight inflation in this instance. I don't even know if I agree so much or just like the Fed itself says that the inflation that we went through, only about 30% of it was a function of demand, right? The other, you had a significant portion of it was a function of logistics and like mismatch products and this and that because of COVID, right? It wasn't a question that we didn't have the productivity or the capacity to meet demand. It was just that it was mismatched for a long time. You're sending shipping containers to places you had never sent it before. To get them back is a lot more expensive. These things are starting to work through the system. Wages contribute a little bit because there has been some wage growth for the first time in decades, essentially. A lot of it is also maybe the plurality of it. This is based upon the Fed numbers, is basically just the corporations seeing the opportunity to raise these rates. And so the Fed comes in, they have one tool to deal with inflation, and that is, they're a hammer. Except for I'm arguing that it's not a nail that they're hitting, it's a screw. And they're doing this, in my estimation, as a way of weakening labor. They are going to kick 1 million people.
How would you do it?
How would I do it? Well, I would deal with it fiscally, or I would just wait. I would wait because you're starting to see the trends all move in the right direction in terms of inflation, and I would wait.
So you wouldn't have raised the
I would have probably done maybe half of what they've done. Maybe.
So 2.5, whatever the number is.
Yeah.
You mean the most recent?
No.
hike?
He's saying
today,
like the whole whatever's happened.
I mean, look at it today, right? Like they're worried about the banks. At the same time, they're like desperate to we need to kick 1 million, 2 million, 3 million people out of work. They're explicitly saying this. And so, that does not make sense to me.
Sam, a guy here, Scott Rodriguez, just said, sorry, but 80% of loans given the last 3 years only required 5% down payment. It was much harder to get a loan in the 90s.
In terms of mortgages?
Yeah.
It's conceivable that it was harder to get a loan in the 90s. I'm comparing it to like the aughts. But I can tell you, I have some very close.
Do you think it's better? Do you think it's a better guideline to put a minimum 25% for anybody to buy a loan, or no 5% down payment is fine?
I think I don't know if the number's 10% or 20%. I'd have to read in to see where we're talking about foreclosures, but we're not having a foreclosure problem right now.
Not yet.
Not yet,
Yeah.
because if he keeps raising the interest rates and decreasing the value of homes. At this type of rapidity, rapid rate, we might. Right. But, the way you avoid that is don't do that.
So if you like this clip and you want to watch another one, click right here. And if you want to watch the entire podcast, click right here.